Okay, well, everybody, welcome to today's Telecom Industry Interest Group for PACE, our next webinar. And it's a pleasure again to have Mark Spracklin from CVA Solutions to lead the session. We hope this is going to be interactive. So as we go along, Mark would welcome any questions you might have, and you can either ask them or you can put them in the chat feature. So today we're going to be talking about simplifying and adopting legacy cost models for profitability and pricing. I think that's a really key issue. I'm excited to hear what he has to share with us today. So having said that, Mark, please take it away.
Yes, hi. Thanks everyone for coming. This is sounds like one of the more boring topics, but this is one of the things I find on every project that it's actually one of the more important things. That models often aren't used for profitability as much as they could be because they're considered built for other purposes like regulatory or legacy reasons. And they think it's too difficult to rebuild them for profitability, when actually it's normally quite simple, just to make some small changes and improve these models, and then you can use them for profitability. So if I come back first of all to the slide I showed on the first presentation, basically these three areas that we're looking at, and where the profitability I find is the key is that you get a complete view of the three. So the costing people can see what the profitability is. The network people who are really interested in building the latest network, again, can see the revenue. They only really see the costs. And really the profitability gives you the overall view. But a lot of models, the legacy models, really focus on this area, which is just the financial area of the business, which will include, of course, the product side, but they often leave out the customer side, and you need that for the profitability. So a lot of what I'm going to talk today is more around adding more detail on the customer side. So again, most models have been built in telecoms anyway. Most models have been built for regulatory reasons. And while they're not suitable for profitability immediately, they are quite easy to adapt for profitability. But the main examples are of the problems is too much detail, especially around support costs. And I keep coming across time and time again. I tell people don't put in too much detail, but finance people just seem to love detail. They seem to think more detail means more accuracy, and that's just not the case. In fact, it's often a hindrance to accuracy by having too much detail, because it's just too difficult to manage it. It's better to aim for sort of 80% accuracy with a higher level first, and then drill into the bigger remaining areas, not try and do a big bang with a huge amount of detail. I mean, I've seen some models that have got like 500 activities, and most of them are really support type activities and don't really bear any relevance to the customer at all. And then the other thing that really hinders models is the speed to update them. So often there's lots of backup sheets in Excel with various calculations that are difficult to update and people don't understand them. I haven't mentioned it here, but automating the data feeds. I mean, when I say automation, it doesn't have to be IT automation. It can be done in Excel, but using formula and things that are easy to update, not a lot of manual effort updating the models. Because profitability models, you really need to have them current. Regulatory models are normally updated once a year. Profitability models really need to be every sort of 3 months. If they're not current, then people just won't trust the results. So this is a typical regulatory model in telecoms industry. And you can see there's one big block at the end, which is the final products. And these are normally the products that are regulated. This is like a mobile to mobile call, an SMS call, a data call, typically around 100 to 200 different types of products. And that's it. It stops there. There's no more. But when you sell things and you price things, you don't price a mobile to mobile call. You normally price bundles of things. So you get a package with voice data, SMS, roaming, maybe content and other things. And most of the regulatory models stop at this point with the regulated products. And if I just go to the next slide down, which is the commercial model, there isn't much difference. Most of this first part hardly changes at all. The main difference is instead of just doing the final product, you're doing the things you sell. So the bundles, the tariffs that you sell, the channels that you sell through. You still have the products, of course. You want to see what those profitabilities are, and the various customer segments. And the customer segments is where it gets quite interesting, and there can be multiple ones of those. Where most models are let down is either around here on the support costs or the retail activities, which I'm going to come on to. The middle bit in grey here is the network, or if you like, the manufacturing cost of the products. And whether you're talking about a regulatory model or a commercial model for profitability, that is almost always the same. Sorry, just as Ralph said, if you've got any questions, please just jump in at any point. So the number one place I find where I can simplify models quite quickly is the support costs. Now, the support costs, there's no real extremely tangible allocation anyway to the final products and services. And often they're just bundled together in an ad hoc type way. But basically, they break into three main areas. Overhead costs like offices and buildings, and these are normally treated quite well based on existing ERP solutions and things like that with SAP and that. So, you know, your office buildings, your furniture, your IT, and then support activities and business sustaining activities. These are where the models often go wrong. So you've got support activities like HR and the internal help desk, that sort of thing. Now, these are activities that are done to support you doing your job. And the driver for those is normally just simply the number of headcount. So that's very straightforward. But often, I find in a lot of models, people put in there as well business sustaining. Some people call it enterprise activities. So finance, the board, CEO, regulatory audit, all those type of things that got no real tangible driver at all. And I had a regulator come to me just last week talking about this with their review of a model and had concerns. And they call it unattributable costs. And basically, these are costs that have got no real tangible relationship to the final products and services at all. And in this model, they were actually allocated based on headcount. So the CEO was distributed across the whole business based on headcount.
And do you recommend?
Sorry.
Do you recommend that business sustaining activities are allocated based on revenue in general?
Yeah, I was going to come on to that, Max. Thanks for jumping in there. Yeah.
I tend to agree.
Yeah. Well, as you know, one of the projects we worked on together, I recommended revenue, and the regulator refused that. They said it had to be cost. But for profitability, I find revenue is the most tangible thing. Yeah, because I've got it on a slide, a few slides on, but I'll jump to that. Basically, the reason we have management there, the executives and everyone else, is to generate revenue for the business. They're not there to support you doing your job normally. They're there to drum up, the revenue. I mean, the alternative maps is you could use profitability, but as you know, that ends up with a recursive allocation, and it gets extremely difficult. But revenue is very simple to use as the allocation.
Could we maybe ask a question for those on the call? And I have a feeling that these buckets of costs are very common across every industry almost. And I'm curious how people treat these business sustaining activities in their organizations, how they allocate them. Maybe either in the chat feature, or you can, just speak up. How does your company allocate business sustaining activities, or maybe not? Maybe there's maybe business sustaining activities is a cost object, but I don't mean to, we can keep going. But everyone in the call could just suggest what they do. Go ahead.
I mean, I think they need allocating and can't be a cost object, and they can simply be tagged in the model so that you can see the profitability with or without it, given that it's, as Mark says,
I can just throw in what I generally recommend to my clients, that when you have a decision for which you need to attribute those costs, for a lot of decisions you don't need to, but for those that you do, that you treat them as a percentage of the other activity costs, because you're managing the business to perform those activities. I would, and a lot of the cases, and it may fit in telecom to do it on revenue, but in many cases, revenue, if you double the sales to something, you're not doubling necessarily the effort. But if you double the amount of work to generate that particular sales item, that would require double the management of the business. So basically, the surrogate, because there isn't really a good way to do it, that we usually recommend is all of the activity cost. And again, that I did deal with a lot of manufacturers, and that then eliminates the pass-through, the impact of thinking the pass-through of material cost has a factor on how much work you have to do, the price of material. So
yeah, I think the slight issue we've come across in telecoms with that is one of your big areas is a call center. I mean, you can almost think of a telecoms organization as some network, fixed cost largely, and a call center and some other bits and pieces. The problem that Mark alludes to, and to be fair, he pointed it out in one of my models, was that you get a very large cost allocation over call center, which tends to be a large cost, but hardly utilizes any thought from senior management. You know what I'm saying? They provide a call center largely just to deal with fault reporting, billing issues, customer service generally. So, but I'm imagining that in a manufacturing organization, what you say makes perfect sense.
The other thing I found is if you attribute costs to different markets, different customer bases, different product lines, those kind of things, there isn't that many business sustaining activities left. They're all skewed towards something. Whether it's your heavier marketing in market A versus B, you have to spend more time supporting product line A versus B. By the time you've taken care of all that, your business sustaining activities, those general ones, aren't very big anymore.
Well, I was going to come on to that actually, because one of the feedbacks we get from the regulator is that your business sustaining activities is too high, right? Yeah. If there were 20%, they say, no, you can't have 20%, you can only have 10%. So 10% of your activity costs, and they might limit them saying, well, you've got too much management in the business. You can't allocate those to your products. And that's a good point. And actually, if you do more detailed analysis of your corporate businesses, you can often find better drivers. For example, finance might do payroll. They might do revenue assurance. The CEO's office might have particular marketing campaigns that they're doing things. Now, when we say business sustaining, we don't mean necessarily the whole department. It's just activities that have got no relationship with any services at all. But if you do a better ABC job, yes, I mean, one of our things is we always try and get them to an absolute minimum. And just coming back to one point you made a bit earlier, most of these models we do are top down, right? So if, for example, you double your output, you don't double your management. Management stays the same. It just means that the outputs get half the management costs. If you're talking about using revenue to allocate them. So it doesn't actually, the volumes don't drive up the management costs. They actually push them down per unit of revenue.
Theoretically.
Yeah, theoretically. But you know what everyone's like. They like building their own little empires. And the regulators, and I've seen this in several countries, they explicitly say that we have to keep business sustaining as a separate line on our final P&L reports, so that we can see the cost with and without that cost. We're not allowed to, for example, which I've seen in a lot of models, hide it by allocating it to different areas within the model, so you can't see on the final reports. Okay, I'll jumped ahead a bit. Some of these things I've already covered on some of the other slides, but I'm saying here it's typically 10 to 20% of cost, so it's not a small amount. And as I said, better quality activity-based analysis, I think, is a way to get that down. We always try and do that. But where they often go wrong is, and Max mentioned this, but is when you try and allocate business sustaining activities to other activities. So finance is allocated to HR and IT, IT is allocated to finance, HR is allocated to finance. And before you know where you are, you've just got almost a recursive loop of costs being allocated to costs. And this makes the model extremely more complicated, and it doesn't really add much value. One of the models I was recently looking at, we managed to get rid of almost half the allocations in the model by just removing a lot of this and basically just taking everything to the end and allocating it based on revenue. So simplifying the model quite a lot, just removing it.
Sorry, Mark, the only issue with that, and it's a requirement that I believe has to be discussed with client at the outset, is whether they care about the unit cost of some of those departments like HR, because then you do have to do something. Otherwise,
yes, no, I agree that.
Otherwise you'll, and I think as you alluded to, and I've seen in a client that you would expect the unit costs to come down as organisations grow of overheads. They don't. They go the other way. They increase.
Everyone building their own little empires.
Yeah. I've seen it in a specific client which started in one building, small building with the CEO, pardon my dogs, sitting, the CEO sitting at a desk next to anyone, and then suddenly a few years later when I went back, there was a massive gold-plated office with, hundreds of finance staff, HR staff, and IT staff. So
no, absolutely, yeah.
And that, unfortunately, from a cost reduction point of view, that does matter. And if you're trying to say benchmark within an organization with multiple offices or geographies, that can be an issue. So I think I agree with you, but I think there's a kind of requirement point there.
I agree, but I think the the detail isn't in allocating between departments. I think the detail can be arrived at by doing better activity-based analysis of these business sustaining cost centers.
Yeah.
Anyway, let me jump on others. We'll run out of time.
Sorry, I'm going to mute myself here and there because my
right, sure, yeah.
apologies. I'm at home and my wife comes home and I have a large number of dogs and they'll make a hell of a racket. So I'm just going to mute myself and come back on as necessary.
Right. Well, Max already mentioned the next one I was going to talk about because it was one of his models. And what was happening was 50% of the business sustaining costs, like the CEO, ended up going to the call center, which the executives had no interest in at all. And that was very, very simple, like a one-day job to change that and fix it. But it was giving quite distorted results because then the call center was being then allocated based on people calling into the call center. And really, all these executive people had nothing to do with it at all.
Sorry, Mark, as a wider point, one of the things I've seen is that an independent review of a cost model always throws up a couple of these weird things, right? And more often than not, they're correct. I mean, there are certain things you can argue about, how you allocate property costs. What's the difference between an owned building where the depreciation is fully depreciated, the depreciation is zero, higher maintenance costs, obviously, versus a rented building, and some of the sorts of complexities around that and the skewing of results. And I guess my question to you is it's quite easy to build a cost model and you run out of time at the end, as one always does on a project.
Yes,
and
of course, yeah.
Effectively, it seems to me, because I've reviewed, I've been part of regulatory review of major organizations' cost models, and you can drive a truck through it. It's very easy to look at someone else's results and allocations and find things. Let's put it that way. Do you have any kind of advice, and or does anyone else have kind of advice on how you review a cost model and the sort of percentage effort, but because it's often not believed, let's put it that way. I've just had a recent example where the CFO of an organization came to me and said, I need to understand every allocation. And I kind of laughed and said, well, how much time do you have? And, the complexity for me is if you've got 300 products and 5 customer groups and 100 activities and 300 drivers in a model, how do you go about satisfying yourself and senior execs that model would stand up? Like I said, the model we're doing at the moment, I already know where it's going. So we did a September run to prepare for the year end, and what we hadn't been told is that they'd reorganized. They said, well, there might be a couple of changes in cost centers, but fundamentally they've actually created an absolute mayhem, which is going to push back on our project deadline massively and give us a problem with time for QA internally on the project team, but more from a wider perspective, the stakeholders in the business. And I guess my question is, how do people deal with that on a wider sense?
Are you? Can I just ask a question? Are you creating these models for a regulatory purpose, or?
Well, they are, and I mean the benefit of doing a regulatory model is it's going to be scrutinised. So you'd better make sure it's right in general. And you tend to have bright people on the other side, and it's much easier, as I say, to pick up a set of results and start pulling it apart than it is to build a model. It's I guess it's a bit like building a new house furnishing it, and the interior designer comes around to have a look at it and goes, well, I don't really like a lot of your color schemes or something. Do you understand what I'm saying? So it's, but by implication, you know, and I'm sure Mark would share the same thing, is, you know, if you imagine that a regulatory model has more external scrutiny, you have to write a methodology proper, you know, that a third party can understand. That's less likely to be the case in just an internal profitability model. You know, so you're more likely to spend more time on making sure your inputs are well structured, making sure your output QA is well structured, that you review a lot of allocations and so forth, and spot any profound errors. And I'm guessing my question is, how do people deal with that on internal profitability models?
Well, my question.
Sorry, go ahead, Jim.
My question would be, why are you trying to allocate the CEO salary to product level? You're taking an inherently fixed cost and trying to make it a variable cost by putting it in there. The way I approach it is leave that in a fixed cost pool, and the sum total of all of your margin over those variables have to cover that fixed cost pool. You're not going to make a decision. Like the call center was a perfect example. If 50% of the salary was allocated there, and then somebody comes back and said, wow, every time a customer calls us, it's so expensive for us to service that, then bad decisions are made. But if you allocate that CEO to maintenance, then maintenance costs are out of line. My approach is keep them out of there because it's not a driver at all.
Right.
Yep.
Yeah,
I guess it depends in the end on the reason why you do the model. Like, you know, if you do a new investment model, you don't want to have any of these costs in, because, you know, whether you invest,
just
you know, build another
flow,
thing, it doesn't require another CEO or even finance or HR. I mean, all of these, you know, for internal purposes, I would say should be excluded, you know, for making the decision, because otherwise, you know, everything looks like, oh, we shouldn't do any of the business development because, well, it's all too expensive.
Maybe if I just explain it in the telecoms for a regulatory model, for example, for profitability model, I agree with you guys. For regulatory model, you're allowed to recover all your costs, right, including the CEO's costs and things on your products and services. So you do want to allocate it. But if you leave it to a pool right at the end, which is what I'm suggesting, which is basically a fixed cost, and then allocate it right at the last minute and keep it separate in your report so you can include or exclude it, you basically got the best of both worlds. But if you hide it in the middle, like this example going to the call centers, and then you've got no control at all. It looks like a variable cost. Yeah. So you double the calls in your call center and you double your CEO costs, which is just not true.
Yeah, I agree with you. Leave it in the pool till the very end, and then you allocate it really evenly over, like you guys said, revenue or something else, so it has equal impact on every product.
Is the other one here.
Yeah.
Yeah.
I will. I can give you. Sorry,
I was just going to say the one thing I like to point out to people when we talk about this is that any cost that you don't associate with something, some output, you're associating it with it on the same basis that you associate the profitability of it. If you say it's covered in the margin, you are attributing it to that product in the same proportion as the margin. If you're saying it's covered in it. So you have to be a little careful when you say we don't include it. But again, depending on what decision you're making, you either do need it or don't need it, or it's important, it's irrelevant, because you need different costs for different kind of decisions. But when people say we just we don't assign it, we just cover it in the margin, well, in that case, you are covering it the same percentage you use for the margin. So
agree. but
Yeah.
keep it out of there.
The slight problem in a fixed cost business. So if you think of an energy company or a railway or road network or telecoms, is 70 to 80% of your costs are fixed anyway. You know, I mean, if I think about home location register, home location register in a mobile network just tracks where you are, right? But you can only buy them in massive increments. Yeah, so you know, I think the minimum size you can buy now is 500,000 customers, let's say. So in a smaller operator in a small country, you know, in the West Indies, for example, Antigua or Bermuda or something, you know, you've got massive spare capacity, and in effect that cost is fixed. So you shouldn't really include it for any decision making. And the problem that then kind of arises in the telecoms world is, well, what on earth do you do with your 70% fixed cost? I mean, the CEO, I think we all agree, if it's irrelevant, it's a fixed cost, and it doesn't affect anything, and shouldn't be taken into account with decision making. But equally, in a big fixed cost business, you know, vast proportion of your costs are fixed. You know, you could argue that actually costing, and it is true to a certain extent, that costing systems in large fixed cost business are actually an utter waste of time, because they have nothing to do with decision making. It's a volume business. It's, you know, a fixed cost business is, how do I increase my volumes so that my unit cost comes down, and therefore my unit price can come down, I can compete in the market better. It's a real issue in these sorts of businesses.
Okay, well, I better go on.
Any ideas for that, Mark?
Yes and no. You're fine as long as you're profitable, but then one day you wake up and find you're not profitable.
Yeah, true.
The so-called death spiral. So I think it needs to be monitored. But yeah, you're making a good point. Yeah. I'll just point out one more thing, then I'll go on. And this is a model, Max, so you were involved as well. This is when we used cost as a markup, and we had basically two main fixed product lines. One had a lot of costs. This was broadband, so fiber broadband had lots and lots of costs because lots of investment. The other one is called leased lines, and basically these are connections to businesses. So when you've got the internet in the business, it's called a leased line. But basically, it's almost the same service. One was very profitable. So one had lots and lots of costs. One had almost no cost. And because they were using costs to allocate the business sustaining, all the cost was going to broadband, which was the unprofitable one, making it unprofitable, more unprofitable. And the one that was very profitable, which was the leased lines, because it was business customers, was getting no cost at all, even though the revenues were about 50-50 between the two areas, which is why we found revenue was a better driver, really. But I'll go on now because we've talked about this quite a lot. So regulatory models, Max also mentioned that if they're done for a regulator, normally there's a lot of scrutiny around the manufacturing cost. So this is the network. How much does it cost to make a mobile call for mobile data? But normally there's almost no scrutiny at all around retail costs like marketing, selling, customer care, because people don't know what to do with those costs. Marketing, for example, you know, what are you marketing? It's very hard to know. So often in these models, there's very little effort put into the retail costs. This is regulatory models, and they're normally just done on a markup based on revenue or something like that, or costs. Treated sort of similar in a way to the CEO, but these aren't business sustaining costs. These are real retail costs that you need to run a retail business. And if you're going to be setting pricing based on profitability, then you need to understand these costs better. And what I find a lot of regulatory models, these costs aren't done very well at all, because they're basically excluded from the costs you're allowed to use with a regulated model. So regulated model normally focuses on the wholesale costs. So this is the cost of producing the not the cost of selling the goods. The reason for this is sort of historical in that it's called accounting separation, but basically you're splitting the businesses into two. And in some countries, it's actually been physically split, like in the UK, where you have your network company, your network operations as one company. It's a BT Openreach in the UK. And then you've got a separate retail company that buys those products from the network company and then resells them. So this accounting separation is sort of a way of splitting a business into two parts, but without physical separation. And this is what most regulatory models do. And normally the wholesale bit is done very well, but the retail bit isn't. So I'm just going to come on to a few issues on the retail side. It's just what I said there. Yeah, so for profitability models, you do need to understand the retail costs. So how much does it cost to sell a customer, the sales acquisition cost? How much does it cost to manage a customer, maintain a customer, customer care, handling problems, that sort of thing. And then you need to split it down into the different tariffs and the customer segments. It sounds like it's a lot to do, but actually it's mainly driven by volumes. So the sales volumes, that sort of thing. But that's not normally a requirement in the regulatory model. But you have to have that in a profitability model if you want to use it for pricing. And before you can come on and do this, first of all, you need to understand your revenues. Now, it might seem obvious that you know what your revenues are, but in telecoms, and I think maybe in other areas more and more, it's not so simple. You don't, for example, buy a mobile-to-mobile call or an SMS. What you do is you buy a bundle, a package that allows you to make, thousands of minutes of calls or SMSs and 10 gigabytes of data or whatever your package is. But somehow you need to get from that revenue, say $20 a month or something. You need to get from that bundle to the actual products that the customer uses, because the bundle doesn't actually incur any network manufacturing costs. The manufacturing costs come from the products. So a mobile-to-mobile SMS data, that's what causes the costs in the manufacturing part of the network. And you have to somehow align those two. And there's two basic ways. And this is where we came across a problem a couple of years ago, that there's a new rule in IFRS, I think it's 15 now, that you need to split the bundle based on the value of the services that are being offered. So, for example, what I mean by that is if you've been offered 10 gigabytes worth of data, okay, the IFRS rules say you have to apportion 10 gigabytes worth of revenue to that customer for the service that they've been offered. This is financial regulatory, not regulatory, sorry, financial statutory rules, under the IFRS rules that you have to do this. The problem is that you don't manufacture necessarily that 10 gigabytes of data. If the customer only uses 1 gigabyte of data, so they're only buying one, but under the IFRS rules, you have to give them 10 gigabytes of revenue. And this just doesn't work for profitability. It's fine for your statutory accounts because it meets those rules. But when you come to profitability, it's no good, because when you price these bundles, you do actually price how much usage you think customers will be making of those services. And that's one of the key things to the pricing, how much of the services they're actually going to use. So the second way of doing this is based on basically usage. And this is the historical way it's been done in the past before the newer IFRS rules. Now, the issue here is if you just try and take the revenues directly out of your GL from your financial systems, you can get extremely distorted results. And I only came across this accidentally, actually, during COVID. And what we found was that the profitability of roaming, roaming is when you go to another country abroad and you have to pay these ridiculously high fees for using another network. What we found was the profitability of roaming went up substantially during COVID. But during COVID, hardly anyone was traveling. So for a start, we weren't expecting profitability to go up, but we weren't expecting it to go up massively. And then we found out it was because finance switched from using the old usage-based rules to new IFRS rules. And basically, even though no one was traveling, so there was no roaming at all, or almost no roaming at all, roaming was still getting massive amounts of revenue. And in fact, some tariffs were getting about 90% of the revenue was just going to the roaming product, which was making the national products like normal data look unprofitable. So most people think there's not a problem around revenue, but it can be quite a big problem. Now, the reason I raise this here is that revenue is often a driver then for the retail services. And if you don't fix the revenue problem first, then the retail allocations don't work very well either. Has anyone else come across this problem with IFRS, or was it really just a telecoms problem?
I'm just trying to figure out where I've ever had to report profitability or revenue to a regulator, and I guess that's never been my job. So it's interesting to hear all of this.
It's not just the regulator, but generally for pricing, the new IFRS rules are not really suitable. Bundled services don't really fit profitability. For example, if you bought a packet of it doesn't really apply to manufacturing. No, it's really more telecoms where you buy a bundle of something like 10, but you only use one of them. It seems bizarre, but this is the way the rules are written.
So you're saying you're not just necessarily for regulatory reporting, but just external financial reporting, you would comply with the IFRS rules.
Yes, yeah, all financial reporting.
Which would distort internal decision-making based on this use service, for example.
Massively. And it messes up profitability hugely as well, yeah. It's a huge issue.
It's amazing. It's an amazing example.
It's a simple solution. And so what it means is if a CEO gets a financial report from finance saying, oh, these are the revenues to this service line, you can't make commercial decisions based on them.
That's something that we always talk about, how information prepared for external financial reporting can be misleading for internal decisions.
It's extremely misleading, yeah. And both methods are actually quite similar, the way of calculating them. And you can build both methods into models as well. It's just most people don't. They just assume that whatever's been done in financial accounts from a revenue perspective is correct. And often I found it's just not. And as I said, well, this isn't about revenue talk. It's really about the models. So I'm just going to come on to the retail side, which is where the other issues come in. So for the retail activities, often, and this is an example of shops. So typically, shops don't sell the services that are manufactured, like a voice call or data. They sell a bundle. That's what they sell you when you go and sign up for a package in a shop. Somehow you have to get that cost of the sales from the shop, which can be quite a big cost, to the different products and services. And this is an example of how we do it for shops. So the first one is an actively based analysis. So how much sales effort does it take to sell a particular package? In our case, I got an example down here. Prepay takes about 5 minutes, but post-pay might take about 20 minutes. So it's not the sales number, it's an activity or time emotion type allocation. So it's the number of them times the effort, but that only gets you to the bundle. It doesn't get you to the actual services. And then the tariff value is the next thing we use. So basically, by doing a calculation with the revenue analysis, we can get a split of the value of the different component parts of that product. But it still doesn't get you finally to the products and services. So often a bundle won't be mobile to mobile calls, for example. The bundle will be voice and SMS calls, maybe in one bundle. It is part of the bundle. So it needs a third level of allocation based on the actual usage of those services. So it's like a three-step process. But the middle one, I put value there because that's how we do the revenue calculation. But the middle one is revenue. So if you don't get the revenue right, then even the allocation of your sales activities goes badly wrong as well. And this is common in many models I've seen. And again, it's a quite easy thing to fix. But the regulators don't normally pick up on this because, again, they just ignore most retail costs. As long as the accounting separation is done and the retail costs are put to one side, sort of excluded from the wholesale costs, then they don't go into much detail. And then the retail sales, there are many others as well. I mean, shops is just the first one. Then you've got dealers who are paid a commission, which is a cost of sale. And then you've got retailers like Carrefour and Walmart, and online and direct business who have their own account managers. The starting point for all of these is good activity-based analysis. And that's often not done in regulatory models in this area because it's not needed for the regulatory reporting. But again, it's quite quick to do. And each one of these, then you've got this sort of three-step process to get to the products and services. But the core of getting this done well is really activity-based analysis. Max, you want to jump in there, or maybe it's dropped off. The next biggest one off the sales channels, then is the call centers. Normally, historically, this has been quite easy. Call centers, Max mentioned earlier, but you can think of a telecoms company as a bunch of engineers and a call center. Often, a lot of the retail sales is outsourced, if you like, to independent dealers and shops like Carrefour and things like that, Walmart. So they do have their own shops, telecoms companies, but a lot of it often is done through third-party outlets. But the call center is the core of it. If you don't have a good call center, then your quality of service goes down, people complain, people leave you, and that's a massive cost. Now, this used to be quite easy traditionally because it was just duration. People call into the call center, and you can monitor how many people call into the call center for how long, and then use that as the allocation. But over the last few years, that's got much more complicated. And you've got all the other channels now, which people are pushing because it's much cheaper. So chat, social media, and email. And a similar thing to the sales channels applies to these as well. Often people call in, they've got a problem with their billing. The billing is related to their tariff. So it's not particularly necessarily related to the product. And again, the first step on that allocation often is, the second step after you've done your activity analysis is revenue. So if the revenue is wrong, the call center allocations go wrong as well. And then the third one is problem tickets. So the problem tickets is where you call into a call center and they can't fix your problem immediately. So they give you a ticket number and they say, oh, someone will call you back. These are actually far more expensive often to do than the call center, because call center is normally quite cheap outsourced, or quite cheap staff who just answer the phone and answer certain questions on the screen. If it's a complicated problem, it normally gets passed on to a more senior team in the business, which might be somebody who deals with billing, somebody who deals with the network if it's a network problem, and these are a lot more expensive. And the same sort of thing applies here. If you don't have the revenue sorted out first, then it's very difficult and dealing with these costs as well. So it's like a cascading thing. If the revenue's wrong, then all your retail stuff is going to be wrong, and your profitability is way out. So the IFS problem causes massive problems in a lot of models, but it's relatively straightforward to fix if you know where the problem is. And the final retail one, which is the hardest of all, and there's no real solution, is marketing and advertising. And often there's no causal driver for this. You can't really do activity analysis. Often what I do is I just ask the marketing guys how much, just finger in the air, how much the effort is for acquiring new customers, how much of it is for retaining existing customers, how much of it is for business, how much for consumer, and then just purely use revenue. Now, even if you've got specific marketing campaigns, like, for example, there's been a lot of 5G ones over the last few years. We've got the fastest 5G. That doesn't necessarily mean it relates to mobile. Often companies like to show off that they've got the highest technology, they're the best. So people stay with them, whether it's fixed or mobile. So just because the campaign is 5G, which is mobile, doesn't mean the marketing is only affecting mobile customers. The same thing with sponsorship of sports teams or racing or things like that as well. And again, most of this comes back to revenue again. And the final area really is the retail data is often very aggregated. So when people call in to the call center or go into the shop, often the only thing that's really recorded is at high level in the CRM system about what they're doing. So whether it's a billing issue, whether they've got a problem with the internet, it's not normally related directly to any particular products again. And the solution to this is actually different. The solution to this is actually trying to do the allocation at the customer level. Now, at the start, I said, don't go into too much detail, which is true. But if you can do the allocation at the customer level, from a high level perspective as an allocation, it's actually simpler to do that than doing it at the aggregated level. Because if you aggregate all this retail data up, the quality of it is often extremely poor. Because most of the data is actually collected by the CRM system, by these agents who aren't paid a lot often, and they just type in any old stuff about what the call was about. Whereas if you can relate that to one specific customer, then within your system itself, you can look up and you can see what tariff that customer is on, what products that customer buys, and then you can use that as an allocation to actually allocate to those products and services. So this is a case where actually having more detail in a sense. It's more detail is probably the wrong word. It's a lower level of the records. Actually simplifies the allocation and improves the accuracy quite a bit. So it simplifies it in this case. The problem is most of the cost allocation systems I've seen cannot deal with this level, this volume of records. So it's not an allocation problem as such. It's just they can't deal with 10 million customers a month making billions of calls. They can only deal with very high level numbers. So it's more of a technology problem that hopefully in the future will get solved. And then I think a lot of these systems will be more accurate. Yeah, so I just mentioned that, but actually there are big advantages of having the data at the individual customer level if the costing solutions can actually deal with that level of detail. Right, and if you can then get the profitability at the customer level, again, this seems like a huge amount more detail, but I've actually been working on, I've done a few of these projects and I'm currently working one at the moment. And actually the allocation part, like I said, is actually simpler if you have the ability to look up the customer and see what the customer is doing. So it actually simplifies the cost allocations. It's just a question of the technology, whether it's able to do it or not. Then if you can get the profitability of the individual customer, and where this goes wrong, this is actually very easy to do from the wholesale network manufacturing side, because if you manufacture one voice call, it's exactly the same cost for every customer. Same with data. But the retail side, it varies massively. So some customers spend a lot more time calling into the call center complaining. They always question their bills. So it varies, the retail side varies by customer massively. But that's all recorded in CRM systems. You don't need to do activity analysis for this. It's all there in the CRM systems. It's a huge amount of detail that most of the costing systems can't cope with. I keep saying detail. It's not really detail. It's volumes. That's the issue, not really detail. But if you can get the individual customer profitability, then you can segment based on profitability. And then you can compare different segments of customers, see which ones are profitable and which ones aren't profitable. And then look at seeing, well, what's the difference between them? Why are some more profitable than the others? And then do something about it. This just reminds me of a strange case I had a few years ago in Africa. And they were complaining that the calls into the call center were far too long. Some people were calling into the call center and hanging up all the lines, and then they'd hang up as soon as a representative went to answer them. And they found out that some people just liked, because calling into the call center in this case was free, and they found out that some people just like listening to the call center music. So they were calling into the call center and listening to music. They changed the music and the call center calls dropped by 50%. Just by changing the music in the call center. I don't know who found that out. It wasn't me. It was just something the call center guy told me. But yeah, understanding individual customer behavior, that's where we're really aiming for with these profitability models. And the key to that really is figuring out the retail side of the equation, which most models don't really deal with very well. And then the final point is that when you identify these customers who've maybe got unprofitable behavior, then you can try and change that behavior, get them to use different products or services, discourage them from calling into the call center. One of the big ones some years ago, I think it mainly stopped now, it was a thing called bill shock. And what they were finding was that some customers, when they went abroad roaming, they didn't realize what the roaming rules were. And they'd come home and they'd have a massive bill, thousands of dollars bill, when they might even pay $20 a month or something. And what they introduced was credit limits on customers. So if you got, I'd say, a $20 a month tariff, then what they've done is they capped that at maybe $50. So at a certain point, if you're roaming and your bill gets too high, they'll tell you that. Or another one they do is they just drop the speed. So instead of you getting very fast internet, you just get extremely slow internet. Or they send you SMS messages saying, oh, you've reached your roaming allowance, or things like that. That's an example. If you can identify this behavior, then you can do something about it and actually try and reduce costs and maybe increase revenue at the same time. But you need to understand your customers to be able to do that. And if you don't understand what's driving those costs, you really can't do that. So that's all I had for today. Thank you. I went on quite quickly at the end there, but I hope you understand the problems we've got here on the telecoms profitability side. It sounds like it's a big problem, but honestly, it's not a big problem. Probably 75–80% of the job's already been done in the regulatory models. But a lot of the people, I think Max mentioned it earlier, is a lot of people just don't trust the results. The results are too old, maybe a year old, because they take too long to update, too much detail in the models. But you can adapt them quite quickly into profitability models. But you have to earn people's trust first and get buy-in to the results.
So I think that's a good time, good place to end.
Hopefully I'm about on time. I had to rush a bit.
For very good timing there. And I have to tell you, I learned a lot today. And thank you for, hopefully everyone else did as well. And thanks, Mark, for another interesting and informative webinar.
Thanks,
Thank you, everyone.
Thanks, all. Thank you.
Bye-bye.